doing the entire question number 5, but I want us specifically to look on question number 5. I want us to look on note number 3. Note number 3 of that question. You can see the wrong question, but we are not doing the entire question. So actually, that is what we are doing next. That question is that from the topic of published financial statement. That is our next topic. Our next what? Topic. So what are we told in this note number 3? Additional information number 3. We are told that 𝐷 Limited estimated an income tax provision of 113.8 million is required for the year which ended 30th of March 2021. And then you're told the balance on the current tax in the balance represent under/over provision of tax liability for the year which ended 31st of March 2022. So then you're told at 31st of March 2021, the tax base of 𝐷 Limited net asset was 292 million less than the carrying amount. The income tax rate applicable to this company is 30%. Now, as far as that note is concerned, note number 3, we basically need to compute two items. Number 1, we need to compute the current tax, which will be charged in the income statement. I hope you can see in part A of that question, we are required to compute, or the candidates were required to prepare the statement of profit or loss. We are going to compute the current tax to be charged there. And number 2, we also compute what? We also compute the deferred tax. Now, if you can be able to recall in our previous session, what we said is that as an accountant, anytime you're preparing the income statement or the financial statement, you can't be able to tell the actual amount of tax to be paid. You just estimate. You do what? You estimate the tax to be paid, and you make what? You make a provision. So once you have made a provision, so we say that this one can give rise to over provision, or basically this one can result to something called what? Under provision. Remember, in this case, we said over provision, this one arises whereby the provision which you created as an accountant is basically more than the actual tax. So that gives rise to over provision, of which we say that this over provision in the trial balance, it will be having a credit balance. On the other hand, we said at a provision analysis whereby the provision which you created as an accountant is less than the actual tax. So this gives rise to other provision, of which we say that this other provision in the trial balance will be having a debit balance. We say that whether it is an over or basically other provision of tax, which arises in a certain financial year, assuming in the year 2024 there was over or basically other provision, we say that this other or over provision will be taken to the year 2025, and actually we say over provision will be deducted from the estimated tax liability for 2025. If it is under provision, still it will be taken to the year 2025. It will be added to the estimated tax liability for what? For the year 2025. So what we need to do therefore, as per the information we have in note number 3, is basically to compute the amount of current tax, the amount of the deferred tax. Simply because, remember what we said in our previous class. We said the amount of income tax, which is basically charged in the income statement, the amount of income tax which is charged in the income statement, this comprises of two components of tax. We have the current what? The current tax. And number 2, we have what? We have the deferred what? The deferred tax. And therefore, that is something you need to note very well, because at this level now, you will not be talking of the corporation tax. If you can be able to recall, for example, in financial accounting, you used to be given corporation tax. You are deducting that directly from the profit before tax. At this level, you'll be dealing with two components of taxes, the current tax and the deferred what? The deferred tax. Yes. So which for the deferred tax, this one can be a deferred tax expense, like what you have computed from the deferred account, which you have prepared here. It can be a deferred tax expense. It can be a deferred tax what? Income. So what I want us to start by computing here, from what we have in note number 3, is the current tax to be charged in the statement of profit or loss, for the current year. If you go to the requirement, the current year ended 31st of March 2021. So that is when the current year ended. So how do we compute this particular amount of current tax? This amount of current tax, we are going to compute that using the information which we have in note number 3, specifically paragraph 1. In paragraph 1, you're told 𝐷 Limited estimated that the income tax provision of 113.8 million is required for the year which ended 31st of March 2021. So basically what you're told is that during the current year, the company estimated the income tax to be 113.8 million. So therefore what you're given here, and if you go back to the trial balance of that question, in the trial balance of that question, you'll be able to see that the figures are given say in thousands of shillings in the trial balance. So for us to be able to compute this amount of current tax, what we do, we take the estimated tax liability. Estimated tax liability for the current year. That is the year which ended 31st of March 2021. So this is the estimated tax liability. As an accountant, you estimated that during the current year, our company will pay, or this company will pay a tax equal to 113.8 million. But remember what you have said. You need to check whether in the previous year, like in this case, in the year 2020, was there over or under provision? If there was over or under provision, you have to bring it to this year and basically you adjust it to this amount. The net amount which you get is what you charge in the income statement as what? As the current tax. Now in paragraph 2, we are told, let's go to paragraph 2. We are told the balance on the current tax in the trial balance represent under or over provision of tax liability for the year 2020. So if you go back to the trial balance, can we go back to the trial balance? To the trial balance. In the trial balance, there is an item we are given share of current tax. I don't know whether you can see that item. That item down there almost at the bottom of the trial balance. So we have current tax, basically an amount which appears on the credit side, an amount of 12,800. 12,800. So this is the current tax. The current tax. And this one appears on the credit side of the trial balance. Remember what you're told in note number 3. Remember what you're told in note number 3, sentence paragraph 2. The balance on current tax in the trial balance, this one, represent under stroke over provision of tax liability in the year 2020. So this is an over or under provision of current tax in the previous year 2020. This is the year 2021. Now we said the examiner specifically will not tell you whether this one was over or under. So what you have to recall is this. An over provision in the trial balance will have a credit balance, and under provision of current tax from the previous year in the trial balance will have a debit balance. And automatically, because this one is on the credit side, this one is what? This one is what? Is what? Over provision. This one is what? Over provision. So being over provision, what do we need to do with that over provision? Do we need to add it here? Do we need to less it here? Being an over provision, we less, we add. We less, we add. Who can tell us? Over provision of current tax from the previous year. Yes, over provision, we said we do what? We less. So what we do here, we less over provision. Over provision of current tax. Of current tax for the year which ended 31st of March 2020. The over provision is basically 12,800. 12,800. We less it there. We less it there. And basically we have 101. So this is now the amount of current tax to be charged in the income board. This is the amount of current tax to be charged in the income statement for 2021. Sasa? Yes. So when, for example, actually we are going to do that question in our next topic. So when preparing the income statement, once you get the profit before tax, one of the items you raise from that profit before tax is the current tax. Now let's go back to note number 3, specifically the last paragraph. The last paragraph you're told is at the end of the year, that is at 31st March of 2021, the tax base of Babu Limited net asset was 292 million less than the carrying amount. So the income tax rate applicable to this company is what? Is 30%. So what you're told in that last paragraph there is that the carrying amount, actually not the carrying amount, rather the tax base. We are told the tax base of Babu Limited net asset was 292 million less. This one was less than carrying amount with an amount of 292 million. Remember, all our figures are in thousands of shillings. We must be consistent. 292. Now, who can tell us what is this? This particular amount here. 292. What is it? What is that particular amount? Which name will be given to that amount? 292 million. Which name will be given to that? which name will be given to that value there? Which name will be given to that value? Which name will be given to that value? Yes, that is temporary difference, because you can see it is the difference between carrying amount and tax base. Sasa, yes. So what we need to do here is basically to determine whether this particular amount, is it taxable, is it deductible temporary difference. Now remember what we said. We say that if the carrying amount, and that is something also we have done in the other question, if the carrying amount exceeds the tax base, is greater than tax base, then we have taxable temporary difference. If the carrying amount is less than tax base, we have deductible temporary difference. In which case, this one we have to compute the deferred tax liability. Here we compute the deferred tax asset. So therefore, for us to determine whether this is taxable or deductible, can we interchange this? We start with the carrying amount. So we start with the carrying amount. Automatically, we're going to change this inequality sign from less than to greater than to greater than. So we'll say carrying amount is greater than tax base. With an amount of 292. So if that is the case, then it basically means that this one will be a taxable temporary difference. It will be a taxable temporary difference. So if it is a taxable temporary difference, what do we compute? We compute the deferred tax liability. And actually, whatever you're computing here, the deferred tax liability, just like the other question, this will be the deferred tax liability at the end of the year. So the deferred tax liability on the 31st of March 2021 will be equal to the taxable temporary difference times what? Times the tax rate. So the taxable temporary difference is 292,000. And then in the same point number 3, we have the tax rate, which is basically 30%. 30%. So this will give us a deferred tax liability of what? This will give us a deferred tax liability of what? 292. So this will give us a deferred tax liability of what? Of 87,600. 87,600, is that what you're getting? 87,600. 87,600. 87,600, is that what you're getting? Yes or no? Yes or no? We try to hurry up because of time. So that is just multiplication. That is just multiplying. Yes. So now this deferred tax liability being the deferred tax liability at the end of the year, this one we take it to the statement of financial position, and actually we recognize this as a non-current liability. We take that to the statement of financial position as a non-current liability. But it's also important for us to determine the amount of deferred tax to be charged in the income statement. How do we determine the amount of deferred tax to be charged in the income statement? So to do that, we must prepare something called a deferred tax account. We must prepare something called a deferred tax account. Although in this case, this one is quite simple because we are preparing this one for just 1 year. For just 1 year. Now, in preparation of this account, what do we record here? Now, first of all, if we go back to the trial balance, can we go back to the trial balance which you're given? To the trial balance. In the trial balance, in our trial balance, there is an item which you're given in the trial balance, which is called the deferred tax. Actually, deferred tax is above the current tax. I don't know whether you can see it. Is above current tax. So we have a deferred tax of how much? 97,600. 97,600. And I hope you can see that deferred tax. That deferred tax of 97,600 is just referred to as a deferred tax. And in this case, it is on the credit side of the trial balance. So now take into account it is on the credit side. Is this a deferred tax asset or is it a deferred tax liability? Because it can either be a deferred tax asset or it can be a deferred tax liability. Will this be a deferred tax asset? Will it be a deferred tax liability? Deferred tax asset or a deferred tax liability? Deferred tax asset or deferred tax liability? This particular amount, which is on the credit side, that one is very simple. Remember the acronym, our acronym DIRA. So in this case, if you're given an item on the credit side, it's very simple. It's for you to know that is a liability. There is no way an asset can be on the credit side of the trial balance. So being a deferred tax liability, that is what we start by recording here, because that is the deferred tax at the start. This is the deferred tax at the end. So we know all liabilities. When preparing a ledger account, all liabilities, they have a credit balance. So we start by recording the balance brought down. which is the opening balance, which is 97,600. So that is the balance at the start. Then at the end of the year, what do we have? At the end of the year, we have this one, deferred tax liability. I've said a deferred tax liability should be recorded in this account, just like what you have done in the other question on the credit side. But if it was a deferred tax asset, we recorded the balance carried down here. So the balance carried down, which is the deferred tax liability, is 87,600. Then what do? We balance our account. We have said the balancing figure is what we take to the income statement. And I hope the balancing figure in this case will be on this side. So this will give us 97,600. 97,600. What is the difference? 10,000? Yes, 10,000. 10,000. So this balancing figure, which is on this side, the record we have said, this one is called a deferred. A deferred tax what? This one is called a deferred tax income. That one is called a deferred tax what? Income. That one is called a deferred tax income. That is basically the amount which we take to the income statement. So this is basically a deferred tax what? Income. A deferred tax what? Income of 10 what? Of 10,000. So that is what we take to the income what? To the income statement. So basically that is what was required as far as that note is concerned. Although I've said we will do that question in the process of in our next topic. In our next topic, you're going to do that particular question. So what I want us to do, we take a short break. There is another question which I want us to do here. Which I want us to do here after the short break. This is a question. These papers are mixed up. They are totally mixed up. It is a question from the sitting of around 2021, 2022. My papers here are totally mixed up. Yes, so the question I want us to do after the break is April 2022. April 2022 question 5B. Actually, I think it's like almost all of these questions for deferred tax is like they are in question number 5. April 2022. Question 5, and because that question will consume some time, so I think we'll just take a short break, and then we come back because I want us to finish the question on time. April 2022, question number 5B. 5B. So let's just take a short break of 5 minutes only, and then we come back. Make sure you have this question with you. So we come back at 9:22. The question here. I want us to do this question here, and we will try and move at a speed. Because of time, I want us to finish the question. So we are told 𝐍𝐿 Limited. I hope you have the question. April 2022. 𝐍𝐿 Limited, a public limited entity, is in the process of finalizing its financial statement for the year which ended 31st of October 2021. So we are told the following information has been extracted from its accounting record for the purpose of estimating the deferred tax balances. So we will not go through this. We will go through it as we answer our question. So we have note number 1, note number 2, note number 3, note number 4, note number 5, note number 6, 7. So what are we required to do here? We are required to compute the relevant temporary differences. And number 2, we are required to prepare the deferred tax account. I want us to start with the Roman 1, basically whereby we are required to compute what? The relevant. In other terms, you are required to compute the temporary what? The temporary differences. We are required to compute the temporary differences, the TD. So what is just important here for us to remember is how do we compute the temporary difference? How do we compute the temporary difference? So in this case, we know to compute the temporary difference to compute the TD. So we just take the carrying amount minus the tax base. minus what? The tax base. So what we just need to do is to go through the information which are given in this particular question from actually note number 1 all the way to note number 5. We are given various items of assets and liabilities. So what we need to do here is just to identify the carrying amount, to identify the tax base, and then we get the temporary difference. So in this case, we have to come up with a table here. In our table, we will have a column for the assets or liabilities we are given from note 1 up to note number 6. The next column here will be for the carrying amount. For the carrying amount. The next column will be for the tax base. And the last column here will be for the TD, the temporary difference. Then if you take the values which are given, I think in note 1, 3, 2, 3, the values they are given in million of shillings. So we will indicate up there that all our values will be in million of what? In million of shillings. We need to indicate up there that our values will be in million of shillings there. Yes, so we just need to go through that information. I'll basically be able to guide you, to give you a number of notes here, a number of notes in terms of how to determine the carrying amount, how to determine the tax base of the various items of asset and liabilities. Because in this case, automatically you're not given those carrying amount, you're not given those particular what tax base. Let's go to note number 1. In note number 1, you're told inventory is stated in the financial statement at the roll of cost, the net realizable value. The company wrote down its inventory by 120 million to a net realizable value of 1130 million. The reduction in value is ignored for tax purpose until the inventory is sold. So what you're given here, you first of all write that whatever you're given in note number 1 is what? Is inventory. Then this note I'll give you here are very, very important. I'll give you some notes which will help you to know how to determine carrying amount and tax base. We start with inventory. Now, number 1, if you can be able to recall from what you did in financial accounting, though there is a small topic we're going to do in relation to this in a part, inventory should be valued in accordance with the International Accounting Standard number 2. Whenever you're determining the value of inventory in financial accounting, you do that in accordance with the International Accounting Standard number 2. And actually, this particular standard requires that the inventory or the value for the inventory should be the lower of the two. Actually, should be the lower of two values, the cost or number 2, the net realizable value. So meaning that this being the value for the inventory, this is the value at which the inventory is recorded in the statement of financial position. Remember, the inventory here we are referring to the closing inventory. Closing inventory, is a current asset. Being a current asset, it go to the statement of financial position as a current asset. So we record the inventory in the statement of financial position at the lower of the 2. And being the lower of, this being the value at which the inventory is recorded in the statement of financial position, this one is the carrying amount. In other terms, we say that the carrying amount of inventory is basically the lower of the 2. The lower of the 2. What about tax base? What about the tax base of the inventory? A tax base of inventory is basically equal to the cost. That is what you just need to know. Anytime you come across this item of inventory, we just need to know cost. The tax base is equal to the cost, and basically the carrying amount is equal to the lower of the two values. Now, let's go back to the information which is given in note 1. We are told the inventory is stated in the statement of financial position at the lower of the two values. And then you're told in sentence 2, the company wrote down its inventory by 120 million to a net realizable value. So in that case, we are given the net realizable value, which is 1113 million. But basically, we are told that in arriving at this value, the value for the inventory was written down. The value for the inventory was written down. In other terms, in arriving at this value, the value for the inventory was reduced with 120 million. So what that means is that we are going to use that information to get what? The cost. How do we get the cost? To get the cost, we will take this 1130 million, and basically we add back 120, because in arriving at 1130, the value for inventory was reduced with 120 million. It was written down. It was reduced with 120. So we get what? What do we get here? We try to hurry up because of time. I want us to finish this question here. This one will give us, what are you getting here? This one will give us what? Will give us 1250 million. 1250 million. So having that, then we just need to move and basically use this particular concept which I've explained here to determine these two values. Carrying amount, we have said should be the lower of these two values. Cost is 1250 million. Net realizable value is 1130. We take the value which is lower. The value which is lower is 1130. The tax base is equal to the cost. The cost is what? 1250. So 1250. So then we get the difference. We take this minus that, and basically we will get a difference of 120. And this one is a negative. Once you take this minus that, you get negative 120. So being negative, that one is deductible. Temporary difference. Make sure you indicate whether that temporary difference is taxable or deductible. If you get a negative figure, it's deductible. So we are done with that. Let's move to point number 2. So what is important is this. These notes I'm giving, make sure you're noting them somewhere. So let's move to note 2. Note 2, we are given the trade receivables. Even before we go through that information, there is also a note I will give here that for trade receivables, and this one also applies to the trade payables. So the carrying amount, this one is equal to the net amount. So for example, we know from financial accounting, whenever you're recording receivables in the statement of financial position, you take receivables and then maybe you less things like the allowance or the provision for doubtful debt. So the amount which you get is the net amount. So the carrying amount is the net. What about the tax base? Tax base is the gross amount. It is the original amount. It is the original amount of receivables before making any adjustment. Before making any what? Adjustment. Let's go through that point now. Having that knowledge. So we are told the trade receivables had a carrying amount. In our case, we already have the carrying amount. And this carrying amount, automatically, this one has to be the net. So there are a number of adjustments which are made in arriving at that what? Value. So we are told had a carrying amount of 450 after making a provision for a general provision for doubtful debts of 30. So in arriving at this value of 450, there's an amount of 30 million which was deducted. And yes, and actually we are told that this provision is not allowed for tax purpose. I think this one is quite simple. So we have the net amount which is 450. How do we get the gross? Who can tell us? How do we get the gross? And we try to hurry up because of time. Betty, how do we get the gross? Vincent, Jacqueline, Jen. Tumepewa, we have what? We have the what? We have the net amount. The net amount is 450. Basically, we know that in arriving at that 450, there is an amount of how much? There is an amount of 30 which has been deducted. How do we get the original value? We add back. So basically, that will give us what? That one will give us 480. And this will, we get the difference, which is basically 30, which is negative. And that is still deductible, temporary difference. So what is important? This. So, and I've said that also applies to payables. So then note number 3, we are given note number 3 here. We are given something called PPE. I'll also give a note for that. PPE, the carrying amount, this one is equal to the net book value or the revalued amount based on what you are given. The net book value or the revalued amount, whereas the tax base, this one is equal to something called the written down value. Remember the other question which we did, the question we started with there, we said in case you're given an item of asset, carrying amount is the net book value, and then tax base is the written down value. Remember the first question we did. So we are given property, plant, and equipment. And moving forward equally, you need to get used to some of these terms because in the lower level, you are not using these terms. PPE, these include all tangible non-current assets. All tangible non-current assets are included here. Motor vehicles, land and buildings, furniture and fittings, all of them, we refer to them as property, plant, and equipment. So we are told the property, plant, and equipment had a carrying amount. We have the carrying amount, 3050, and the tax base. In fact, this one is quite simple, of 20. 750. And then you're told during the year, I'll be able to explain the last point. We are not going to use it here, but I'll be able to explain that last point. First of all, we put an X to that because we are going to use it in answering Roman 2. So first of all, we just keep that last paragraph, but I'll be able to explain how we are going to use that gain, that revaluation gain. So, but in our case, what we need is these two values, 3050 minus 2750. And basically that will give us 300, which is positive, and this is taxable temporary difference. Is taxable temporary difference. Okay, so we move to point number 4. Point number 4, we are told during the year which ended 31st of October 2021, development expenditure amounted to 480 million, was capitalized, and we are told amortization of 20 million was charged for the profit or loss, to the profit or loss. This development expenditure was allowed for tax purpose in full during the year. Now, let's also, let me give a note for that. Basically, generally, we refer to this as intangible assets. Intangible asset. So intangible asset, basically, these are the costs which are incurred by the company, costs incurred and capitalized. These are costs incurred and capitalized. You need to understand what you mean by that. So when we talk about costs which are incurred and capitalized, these are the costs which the company will incur. For example, whenever the company is developing a new product. Now, those costs, are they taken to the income statement and deducted from the total income? No. So what will happen is that once those costs have been incurred, they are capitalized. Being capitalized means that those particular expenses or costs will be accounted for as assets. In fact, they are referred to as intangible assets. They are referred to as what? Intangible assets. And I'll give good examples of these costs which are incurred and capitalized. One is development expenditure. Development expenditure is an expenditure incurred in coming up in developing a new product. We know that if the company is developing a new product, there's huge costs which are incurred. The company may be required to buy some machines. The company may need to do some market research. Will this product be acceptable by customers? The company need to invest in marketing. There is huge cost incurred by the company developing a new product. That cost should be capitalized, and actually that is done in accordance with IAS 38. Another good example is like these telecommunication companies, Akina Safaricom, Akina Airtel. Usually they are required by Communication Authority for them to be allowed to operate in Kenya. They must pay a license of like the next 5 years. So you may hear a company like Safaricom being required to pay to the government like a license of 5 billion. 5 billion to operate in Kenya for the next 5 years. It is obvious that once that amount has been paid, that license has been paid, which will enable the company to operate in Kenya for the next 5 years. That company cannot treat that as an expense in the income statement. So what happens is that cost is capitalized. It is treated as an intangible asset, and then it will be amortized. To amortize is to gradually write off. It will be amortized in the next 5 years. So any intangible asset which arises from capitalization of an expenditure, how do we determine its carrying amount? How do we determine its carrying amount? How do we determine the tax base? Now, carrying amount, this one is equal to the cost. This one is quite simple, minus amortization. Minus what? Amortization. This one is quite simple, for example, from the information which you're given there. And then this one, tax base, this one is equal to amount, allowable for tax purpose, allowable for tax purpose in the future. In what? In the future. So when we talk about amount allowable for tax purpose in the future, we are referring to the amount which will be treated by the company's allowable expense in the future. How much amount will be deducted from the total incomes of this company in the future when the company is computing the taxable profit? In most of the questions you'll come across, the examiner will tell you that when this cost was incurred, for example, you can be told the cost was incurred during the current year, the full amount was treated as allowable expense. So if the full amount was treated as allowable expense, either during the current year or in the past, it automatically means that the amount which will be allowable for tax purpose in the future automatically will be zero. Now, what you need to note is that if you have a business and maybe you have incurred an expense of 20 million during the current year, the year 2026, and you treat this as allowable expense. By treating it as allowable expense, you have deducted that from your total incomes in determining the amount of tax you are going to pay to the government. Now, it is obvious that in the future, there is no way the taxman the Kenya Revenue Authority will allow you to deduct this from your future incomes, to treat this as a rubble expense again in the future, because by doing that,